All right, let's talk ReNew Energy. They just dropped out Q2 numbers, and honestly, the market's reaction was a bit of a head-scratcher. So today, we're going to break down their November 10th call, look past the headlines, and figure out what's really going on. Let's get into it.
And here's the paradox right up front. It's a classic mixed bag. You've got revenue looking great, a solid beat there, but then you look at the earnings per share, and it's a miss. So that good news on sales got totally overshadowed, leading to a really choppy day for the stock, which, ended up finishing down.
All right, so let's get into the actual results. We're going to look at what the market was chewing on and why everyone seems so conflicted. Okay, check this out. This is where you see that split perfectly. Revenue, absolutely fantastic. $434 million, that's up 29% from last year. Really strong. But then you look down at the bottom line, the EPS, and it's only 13 cents. The street was looking for 17, and that 4-cent miss, that's what really got people talking and, frankly, selling. Now, let's talk about the good stuff, because there was a lot of it. And what's really interesting is that if you peel back the layers here, you see the bull case for ReNew is really shifting. It's all about this big strategic pivot they've made. And man, is it starting to pay off. So you might be asking, where did that 29% growth come from? Well, it boils down to one word: execution. These guys have been on an absolute tear, commissioning over 2.1 gigawatts of new projects in the last year alone. I mean, that is a massive amount of new capacity to bring online. And this is the real game changer. Their manufacturing business, it's not some little side hustle anymore. It is a core part of the story. It's doing so well, in fact, that management just bumped up their full-year EBITDA guidance for that segment. We're talking a 2 billion rupee increase. That tells you they see some serious, durable strength there. And it's not just about growth. They're also getting their financial house in order. Look at the leverage. It's down to 7 times net debt to EBITDA. A year ago, that number was 8.6. That's a huge improvement, and it shows they are very serious about de-risking the balance sheet. So when you put it all together, the bull case is pretty compelling, right? You've got fantastic execution, this manufacturing business that's just booming, and they're cleaning up the balance sheet. And all of this is happening with some major tailwinds at their back. We're talking a sovereign rating upgrade for India from S&P and helpful policy changes like tax cuts on their components. It's a pretty powerful combination. Okay, but it wasn't all smooth sailing. Now we got to talk about the other side of the coin. Despite all those positives, the quarter had some pretty significant headaches and headwinds. First off, something they really can't control: the weather. India had this crazy long and intense monsoon season, and that directly hammered their solar generation. And we're not talking about a small impact here. It was a 1.7 billion rupee hit to adjusted EBITDA, just from the weather. And if the weather wasn't enough, they also had grid issues. Basically, transmission lines got clogged up, especially in Rajasthan, leading to something called curtailment. The analogy is perfect. It's like a traffic jam for electricity. They had the power, they were ready to sell it, but there was nowhere for it to go. And get this, that cost them about 10 billion rupees in lost revenue in just the first half of the year alone. That is a massive number. And then there's this. Management got pretty candid about a slowdown in getting new contracts, what they call power purchase agreements, or PPAs, actually signed. The CEO basically said, look, it's tough to predict when these things will close. And that's a big deal, because they're sitting on about 6 gigawatts of projects that have initial approval but no final signed contract to lock in the revenue. So you add it all up, this cautious tone on getting new deals signed, their smart but still growth-limiting decision to avoid bidding on some battery projects they think are too aggressive, and the fact that those awesome manufacturing margins are probably going to come back to earth, well, it all points to the idea that the incredible revenue growth we've been seeing might hit some speed bumps in the near future. So with all those headwinds, you'd think they might be dialing back their expectations, right? Well, no, they held their guidance. But the whole story, the whole stock, is now living under this giant shadow of a potential corporate buyout. And they were pretty firm about it. They reiterated their full-year guidance, which is a big signal of confidence. They're basically telling the market, hey, we see these weather and grid problems, but we think they're temporary. They're not a long-term issue. They still think they can hit the high end of their targets, assuming things get back to normal. But really, this is the elephant in the room right now, the go-private deal. A consortium of big players made them an offer. The board's special committee likes it and has asked for a formal binding proposal. So now everyone is just waiting.
Once that final offer lands, you're looking at potentially a 7 to 8 month window before the whole thing could close. It puts a huge question mark over the stock.
All right, so let's put it all together. What's our take on ReNew? What should you be looking for?
The story here is just incredibly balanced. The bull case is all about that vertical integration into manufacturing and how they're fixing the balance sheet, all with a great macro backdrop in India. But the bear case is just as real. You've got these operational hiccups from weather and the grid, uncertainty on new contracts, and of course, the go-private deal hanging over everything. So this is the big question, right? The stock dipped after earnings and then bounced back. So is this price a solid floor, supported by those strong fundamentals, or is it actually a ceiling, capped by whatever price this go-private deal might end up at?
Because of that balance, we're calling it market perform. We just don't see a ton of upside from here, mainly because of that potential buyout price. And at the same time, the operational risks are real enough that we can't get more bullish than that.
So here's how we're thinking about it for the next call. Our thesis is simple. ReNew is a company in transition. The market gets the manufacturing story, so that's priced in. But the risks and the buyout deal are capping the upside. We think the stock is basically going to trade sideways until we get a hard catalyst, like a final binding offer. And that actually sets up a pretty interesting trade idea, a pair trade. You go long ReNew because its manufacturing business acts as a hedge, and you short a basket of other renewable companies that are pure play operators, the ones who are way more exposed to all those supply chain and policy risks.
This is not financial advice.